It's interesting when you think about making money through investments, right? For a lot of people, faith really guides those financial choices.
Absolutely. And one area where that really comes into focus is investing in company stocks according to Sharia or Islamic law.
Exactly. And did you know that for centuries, this whole idea of investing in stocks was actually viewed with, well, quite a bit of suspicion in Islamic finance?
It was, yeah. Which makes the situation today quite remarkable, with millions participating globally while trying to follow Sharia principles.
It's a huge shift. So how do we get from that early skepticism to, a widely accepted framework?
It's a really fascinating evolution, actually. It's all about interpreting timeless religious texts, but in the context of financial systems that are constantly changing.
And that's what we're digging into today. We're diving deep into a specific document that really unpacks this whole transformation. It lays out the Sharia guidelines people use for trading company stocks, well, right now.
Yeah, and our mission here really is to pull out the key ideas from this source material. We want to look at the historical shifts, the reasoning behind the rules, and those practical standards that govern Sharia-compliant stock investing today.
So by the end of this deep dive, you should have a much clearer picture of the framework, what goes into deciding if a stock investment is considered okay or permissible.
Hopefully.
Yes. Okay, so let's start back then. If you go back before, say, the 1990s, buying shares in a modern company, it wasn't a simple yes for many Islamic finance scholars, was it? What were the main hangups?
Well, the source we're looking at highlights several key things that made them hesitant. They looked at the stock market and saw elements that seemed to clash with really core Sharia rules about financial deals.
Like what specifically?
Things like gambling, the Arabic term is makamara,
Yeah.
or excessive ambiguity, maybe uncertainty about what you're really getting into, that's gharar.
Okay, so if it felt too much like a game of chance, or if the details were fuzzy.
Precisely. And then there were concerns about usury or riba potentially creeping in. Plus, there's a fundamental principle in Islamic sales.
Huh.
You shouldn't sell something you don't actually possess right at that moment. That's Malisa Indak.
Selling what you don't own.
Right. And early stock trading, or at least the understanding of it, seemed to kind of bump up against these forbidden elements.
And wasn't the actual structure of the company itself also a sticking point? The whole limited liability thing?
Yes, that was another issue. You see, traditional Islamic partnerships often meant partners had unlimited liability. So this modern concept, al-masuliyah al-maduda, limited liability, where your risk is just capped at what you invested.
Yeah.
Well, that was a pretty new structure. It didn't have a direct equivalent in classical Islamic contract law. So it needed, careful scholarly assessment.
Okay, so you've got these pretty significant hurdles: potential gambling, fuzziness, usury concerns, selling what you don't own, and this new limited liability structure.
Yeah.
You can see why their early views were skeptical. But then something really changed. There was a shift.
Yeah, this is where the source points to a really significant turning point happening around the 1990s. A key moment was a resolution from the International Islamic Fiqh Academy in Jeddah. That was in 1992, or 1412 in the Hijri calendar.
The Fiqh Academy. Okay, so what did they decide? What was the big takeaway?
Well, the core outcome was honestly a landmark decision. It basically stated that investing in companies was permissible jaiz as long as their main goals and activities were permissible, or mashru'a.
So the primary business being legitimate in Sharia terms, that was the key.
That was a crucial factor, yes, the underlying activity. And importantly, the resolution also tackled that limited liability issue we just talked about.
What did they say about it?
They deemed it acceptable. Essentially, it removed that specific historical barrier, but with a condition. As long as everyone dealing with the company knew and understood that the liability was limited.
Right. Transparency was key. It feels like they were sort of catching up with the reality of how modern businesses worked.
I think so. And the source notes this decision fits nicely with a core Islamic financial principle, al-gun bil gurm.
Al-gun bil gurm. What does that mean?
It basically means profit comes with risk or loss. The idea is if you're accepting the risk that you might lose your investment, you're entitled to the potential profit. Limited liability just makes your maximum risk clear.
Okay, so the 1992 resolution gives the green light, essentially, for investing in companies if their main business is okay. But thinking practically, finding companies out there, especially big global ones, that are like 100% pure with absolutely zero connection to anything impermissible, That must be incredibly hard, right?
That's exactly the practical problem that popped up next. Even after that resolution, the source points out finding enough companies on a global scale that were totally clean in every single part of their operations or income, well, it was very difficult. The source says, Lam yukumbil adad al-kafi, there just weren't enough of them.
Right. And I guess that's what led to the development of all these detailed rules and filters, the screening processes people use today.
Precisely. This real-world issue pushed Islamic financial institutions and scholars, big names like the Dow Jones Islamic Market Index, the Malaysian Securities Commission, AAOIFI, Dubai Financial Market, Al Rashi Bank, others too, to develop specific screening standards, guidelines really. They're called Dawabit Sharia.
Dawabit Sharia, okay.
And their purpose was to figure out how to assess if a company's stock could be considered Sharia-compliant, even if it had some, let's say, minor imperfections.
So the source gets into the details of these standards. It mentions that while different groups might have slightly different numbers or ways of calculating things, they generally focus on three main areas. What's the first most basic rule?
The absolute first check, the one you can't compromise on, is the company's core business. The primary purpose and activity must be permissible, Garad wa nashat al-sharika al-asli muhan. Meaning, if a company's main gig is, say, making alcohol or running a conventional interest-based bank or operating casinos, its stock is immediately out. Impermissible.
Makes sense.
The source actually links this to a Quranic verse about cooperating in righteousness and piety, al-bir wal taqwa. And some standards even go a step further, requiring a check that if the company's official charter lists any forbidden activities, those activities must be effectively inactive or disabled, tatil hatihi al-agrat.
Okay, so rule one. The main engine of the company has to be clean. Once you've cleared that, what's the next thing these standards look at?
They shift focus to the company's financials, specifically its assets and debts. The general rule here is that the majority of the company's assets and debts must be permissible. Aghlab amwal al-sharika wa duyunuha mubahan.
The majority.
Yes. This uses a key principle from Islamic jurisprudence, al-hukm lil-ghalib.
Which means?
The ruling follows the predominant. So if the bulk of the assets and debts are okay by Sharia standards, the overall status can lean towards permissible. It allows for, small amounts of impermissible stuff within the finances.
And this majority part, this is where we start seeing differences between the various standards, isn't it? How they actually measure that majority.
Exactly. This is a key area of variation, the source points out. The standards can differ quite a bit on what exactly they measure, like for debt, do they only look at interest-bearing loans or all kinds of debt, and also how they measure it.
How so?
Some compare the impermissible portion assets or debt against the company's stock market value. Others use the company's total assets as the benchmark. And some even use whichever is larger market value or total assets.
Why the difference between using market value and total assets? Is there a reason behind that?
Yeah, the source touches on this. It relates to slightly different views on what a share fundamentally represents. One perspective sees a share mainly as a stake in the company's net assets or its equity. So comparing to market value or book value might seem more logical from that angle.
Okay.
Another perspective might view the share as representing a piece of the company's total assets. So the choice of denominator market value, total assets, kind of reflects these different technical ways of thinking about what share ownership actually means.
Interesting. Okay, so check the core business. Check that the majority of assets and debts are permissible. What's the third main screening criterion?
This one looks at where the company's money is coming from, its income stream. The standard here requires that the majority of the company's revenue must also be permissible. Alab irad al-sharika mubahan.
Majority again. So similar to the assets and debts rule.
Similar idea, yes. It means that a small percentage of impermissible income, or irad muharram, may be from some minor forbidden side activity, or, more commonly, interest income earned on cash holdings, is tolerated under this rule.
Tolerate. But how much is tolerated? Is there like a single number everyone agrees on?
No. And this is another major point of variation the source highlights. Different reputable standards set different thresholds for this tolerated amount of impermissible income. You'll see figures like 5% of total revenue, sometimes 10%, even up to 20% in some standards.
Wow, 5 to 20% is quite a range. How do they justify allowing any impermissible income?
Well, the source draws an analogy. It compares it to how Islamic law sometimes tolerates tiny amounts of uncertainty, gharar yasir, or minor unfairness, gavin yasir, in other types of valid contracts. The idea is that sometimes a very small impurity might be overlooked to allow for necessary transactions to happen.
Like a practical concession.
Sort of. And it's also worth noting some standards, like the one from the Dubai financial market mentioned in the source, might even exclude incidental interest income, like interest earned passively on bank accounts from this specific calculation.
Okay, so the company passes the main business check, and the majority of its assets, debts, and income are permissible according to whichever standard you're using, with those varying thresholds. But you mentioned there's still another step for the investor, right? Even if the stock passes the screen.
Yes, absolutely. This is the crucial step of purification, or tathir.
Tathir.
Right. Even if a stock meets all those majority permissible criteria, and let's say you receive a dividend or you sell the stock for a profit, any known portion of that income or gain that came from the company's minor impermissible activities or income sources, well, you, the investor, cannot keep that portion for your own benefit.
You can't keep it, so what are you supposed to do with that specific amount?
That impermissible bit has to be purified. You do this by donating it to charity sadaqah. The source is really clear on this. A Muslim isn't allowed to personally benefit from forbidden earnings. La yajuz lil Muslim and yantafiya bi.
So you calculate the impure part and give it away.
Exactly. The idea is to cleanse your earnings from that non-permissible element.
And I bet the standards differ on when you need to do this purification too.
You guessed it. The source points out variations here as well. Some standards might say you calculate and purify based on the company's results over its financial year, nihayat al-fitra al-maliyah.
At the end of the year, okay.
Others might link it more directly to when the company actually pays out dividends or distributes profits. Wat taksisa sharika lil awaid al-maliyah.
When you actually get the money.
Right. And there's even some discussion about whether purification is tied simply to owning the stock during the time the forbidden income was earned. That's called tathir al-milkiyah, purifying the ownership itself. Or if it's only about purifying the forbidden portion of distributions, you actually receive tathir al-tadsi at, even if maybe you sold the stock before the dividend was paid out.
Wow, okay. That's quite detailed. So it's a whole system. Screen the business, screen the financials based on majorities, and then this final purification step for the investor.
Yeah.
But stepping back a bit, it might seem a little strange to some listeners. If Sharia emphasizes purity in dealings, why do these standards allow any impermissible stuff in the financials at all? Even these small tolerated percentages for assets, debt, or income. Why not just demand 100% purity for criteria 2 and 3?
That's a really good question, and the source actually addresses the justifications for this tolerance. It comes down to a mix of practical necessity and established legal principles.
Okay.
One key argument revolves around the concept of public need, al-haja al-amma. The idea is that in certain situations, a widespread public need can be treated similarly to a specific necessity, darura kasa, which might allow for some exceptions to general rules.
And the public need here is investment.
Essentially, yes. The argument is that people, need viable ways to invest their money in the modern economy, and governments also need ways to channel wealth towards development, often through these large companies. In today's complex global financial system, insisting on absolute 100% purity in every single aspect of every company would make Sharia-compliant investing practically impossible for most ordinary people.
So it's partly a pragmatic approach to enable participation.
That seems to be a major part of the reasoning, yes. The source also brings up another legal principle. The idea that mixing a small forbidden part with a large permissible part doesn't automatically make the whole thing forbidden. Ikhtilat juzuz muharram la yajal majmu'a mal muharraman.
Say that again?
Ikhtilat juzuz muharram la yajal majmu'a mal muharraman. Basically, a small mix of the forbidden doesn't necessarily spoil the whole pot, especially when the vast majority is permissible. The shareholder's main investment is seen as being tied to the overwhelmingly permissible assets and activities of the company.
Okay, I think I'm getting the picture. This deep dive has really taken us on quite the journey. We started with those early understandable doubts about stock trading based on classical Islamic principles.
Right, the concerns about gambling, ambiguity, and so on.
Then we saw that pivotal 1992 resolution that really opened the door by focusing on the company's primary activity.
A major turning point.
But that led to the practical challenge. Finding perfectly clean companies is tough.
Very tough, yeah.
Which then led to the development of these detailed screening standards we've been discussing. Checking the core business, ensuring the majority of assets and debts are permissible, the majority of income is permissible, with those different percentage thresholds.
And applying different calculation methods for those ratios.
Right. And all of that capped off with the requirement for the investor to purify any identifiable impermissible portion of their earnings through charity.
It's quite a sophisticated framework, really, developed over time to try and bridge the gap between timeless religious principles and the realities of modern global finance.
It really is. Which leaves us, I think, with a pretty interesting final thought for you, the listener. We've seen clearly that different, very reputable Islamic scholarly bodies and standard-setting organizations have looked at the same issues and arrived at slightly different conclusions.
Especially on those tolerance thresholds, is it 5%, 10%, or 20% for income? And how exactly do you measure those financial ratios against market value or total assets?
Exactly. So, given these variations, these differences in expert interpretation and methodology, how does an individual investor trying to follow Sharia decide which specific standard, which set of guidelines, is actually the correct one for them to follow when making their own investment choices?